The Central Bank's Monetary Policy Committee raised the central bank's rate, popularly referred to as the CBR, by 0.75%, an increase that is nearly 3 times the usual adjustment of 25 basis points, which banks have become accustomed to. Analysts contend that CBK is finally admitting that the amount of money in circulation in the economy, or liquidity in financial terms, is too high. Following the move to raise the CBR, commercial banks are now expected to raise their interest rates to cover up for the increased cost of funds, as evidenced in August this year when banks raised their interest rates by between 1% and 2% after central bank tightened the rules for the overnight lending window. Analysts say the more worrying factor is the 91-day Treasury bill rate, which has hit double digits to stand at 11.67%. A comparison indicates that the 91-day T-bill rate has a direct impact on the movement of interest rates. For instance, the highest lending rates were recorded between January and March in the year 2000, with interest rates ranging between 25.14% and 23.76%. In contrast, the 90-day T-bill rate varied between 20.3% to 11.28%. Fast forward to January this year, when interest rates stood at 14% compared to the 91-day T-bill rate of 2.46%. By July this year, the T-bill rate stood at 8.99%, pushing up interest rates to 14.14%. The T-bill rate currently stands at 11.69%, and banks are now grappling with the possibilities of raising interest rates. The last time the T-bill rate was 11.63% was in October 2001, and the interest rate then was 19.77%, meaning that borrowers should be ready to pay interest rates as high as 19%. The only mitigating factors are the possible increase in the rates of default and the likelihood that inflation may ease due to the current short rains. Now, this may dissuade banks from charging higher interest rates, at least for the short term. Henry Githaiga, Citizen Business.